It is the late 1860s, and you are standing in Omaha with money to invest. Ahead of you, Union Pacific is pushing west. Every new mile promises something valuable: passengers, freight, access to towns, farms, cattle, supplies, and eventually a route across the continent. The first calculation looks almost too easy. More track means more trains. More trains mean more traffic. More traffic should mean more money for the people who own the railroad. Except the railroad has a problem before it earns a single fare. A mile of track has to be surveyed, graded, bridged, railed, equipped, and financed before it can carry enough business to justify what it cost. Federal legislation helped Union Pacific meet that problem with land and government-backed financing tied to construction. So, the question is not simply whether the trains could make money. If you invested in a Wild West railroad, what actually made you rich? Union Pacific was a railroad company, but that label hides the scale of what investors were buying into. This was not a business that could open one room, make a few sales, and expand from cash already earned. The railroad needed a long, connected network before much of that network became fully useful. Union Pacific pushed west from Omaha. In 1869, its line met Central Pacific in Utah, completing the first transcontinental railroad connection. But the tracks were only one layer of the business. Shareholders held equity in Union Pacific. Bondholders supplied debt capital. The federal government supported construction through legislation, land, and credit mechanisms. Company management had to operate the finished network. Contractors were paid to build it. Those roles were connected. They were not the same. That distinction is visible in the surviving record. Union Pacific shareholder reports from the early 1870s show the operating company earning money from passengers, freight, mail, express, and other services. Government and congressional records reveal another layer around construction and financing. No single surviving account gives us every dollar that moved through every related company. But the evidence is strong enough to separate the positions. The important question becomes much sharper. Who earned money from the railroad and when? Start with the route. Before rails are laid, surveyors decide where the line will go. That choice is already economic. It determines which towns, farms, mines, and markets can reach the system. A weak route does more than waste surveying money. It can weaken traffic for years. Then come grading, bridges, ties, and rails. All of them absorb money before they earn any. Once the line exists, the spending changes rather than stops. Track has to be inspected. Bridges have to carry weight safely. Damaged ties have to be replaced. The network becomes an asset, but also an obligation. Locomotives add another layer. They need crews, fuel, repair facilities, and replacement parts. Passenger cars and freight cars create carrying capacity, but they wear out as they produce revenue. Stations and depots concentrate the business. Passengers board there. Freight enters and leaves the system there. Local roads meet the railroad there. Telegraph connections help coordinate movement across a line too long for any one employee to see or control directly. So every new mile does two things at once. It opens another stretch of territory from which the railroad may earn revenue, and it adds another stretch of infrastructure that has to be financed, staffed, maintained, and protected. The valuable asset is not one locomotive. It is the network. And a network this large has to be paid for before it can pay for itself. Historical reconstructions of Union Pacific's early finances show how large that financing problem became. The physical railroad has been estimated at roughly $60 million in construction cost. The financial structure surrounding it was larger. Historical compilations place government bonds at about $27 million. First mortgage bonds added another $27 million. Land grant bonds were a little over $10 million, and income bonds more than $9 million. Together, bonded indebtedness reached roughly $74 million. Issued stock added about $37 million more. That does not mean $111 million in cash was poured directly into rails, bridges, and locomotives. Securities were issued for different purposes and could be sold under different conditions. The business meaning is simpler. The railroad sat inside a financial structure much larger than the physical objects a passenger could see from the platform. That difference matters because construction cost, securities issued, and cash actually raised are not interchangeable. A bond sold below its face value could create less immediate cash than its stated amount suggests, while still leaving a claim that had to be honored later. The capital stack therefore tells us about the scale of financing, not a single pile of money spent in one place. For the shareholder, the stock represented an equity claim. For the bondholder, the railroad represented debt that was supposed to pay. The federal government supplied important forms of assistance while retaining claims of its own. Management then had to turn all of that financed infrastructure into a working transportation system. So, the first challenge was never selling a ticket. The first challenge was raising enough capital to build something capable of selling one. And the moment construction solved that problem, it created recurring ones: debt, interest, maintenance, and the need for reliable cash flow. The railroad was open. The spending was not over. A railroad can run fewer trains when business weakens. It cannot instantly become a smaller railroad. The track still stretches across the same distance. Bridges still need attention. Stations still require people. Locomotives and cars still need repair. Administration continues. Financial claims remain. That is the pressure built into a capital-heavy network. Revenue can fall much faster than the cost structure can shrink. Labor makes that system move. Union Pacific construction and operation required surveyors, engineers, graders, track crews, bridge workers, locomotive crews, station employees, and maintenance workers. Historical evidence shows construction crews that included immigrants, Civil War veterans, and formerly enslaved workers. But there is no single reliable wage figure that can stand for every Union Pacific worker across the entire construction period from 1865 to 1869. Different jobs, locations, and conditions produced different labor arrangements. So the exact representative wage remains unknown. What we can say is that labor was not one simple expense. Skilled engineering, heavy construction, train operation, station work, and maintenance all drew on different kinds of workers. The same was true of supplies. Rails and heavy equipment absorbed capital. Timber went into ties, bridges, and structures. Locomotives consumed fuel. Rolling stock needed repair. Maintenance materials had to move through a network spread across huge distances. That creates a chain reaction. If material or equipment costs rise, repairs and construction become more expensive. Those needs cannot always be postponed safely. If financial obligations are already heavy, the cash cushion narrows. And one of the most important costs in the whole system is easy to miss because it is not lying beside the track. Capital has a cost. Borrowed money creates claims. Creditors expect repayment. Securities have to remain credible. A railroad can have busy trains and still feel financial pressure if the structure above those trains becomes too expensive or too hard to refinance. The network now has to earn enough to support itself. That brings us back to the part everyone sees: the traffic. Passenger revenue is the easiest part of the railroad business to picture. A traveler buys a ticket and pays for distance. But the railroad is not selling seats alone. It is selling carrying capacity. Freight cars can move agricultural produce, livestock, manufactured goods, supplies, and other commodities. Surviving Union Pacific reports separate passenger and freight earnings, along with categories such as mail, express, and miscellaneous services. Government transportation added another customer for the same tracks, locomotives, stations, and crews. That matters because one physical network can serve several paying needs at once. And the records also correct another tempting exaggeration. Transportation was not some decorative business hiding a purely financial scheme. Early 1870s operating figures show Union Pacific generating substantial revenue and a meaningful operating surplus after expenses and taxes. The trains mattered, but a profitable railroad still does not tell us who became rich. Corporate operating surplus is not the same thing as a shareholder's personal wealth. To answer that question, the money has to be followed beyond the ticket window. The first extra layer is still transportation. Freight expands the customer base beyond passengers. Mail and express expanded again. Government traffic could add payment for moving troops, supplies, mail, and public stores. One railroad therefore supported several revenue streams through the same underlying network. Land added another source of economic value. Federal land grants supported railroad development, and land connected to the route could be sold or used to encourage settlement. New farms and towns could mean future passengers, future freight, and more local business for the railroad. But that does not make Union Pacific secretly a land company. Land mattered. Transportation remained central to the operating business. The deeper shift appears when we stop asking only what the railroad sold and ask what it bought. It bought construction. Union Pacific had to pay contractors to turn surveys into grades, bridges, track, stations, and a functioning route. Among the most important companies in that story was Crédit Mobilier, a construction company tied to Union Pacific insiders. That relationship became famous because people who influenced the railroad could also hold interests in the company receiving construction payments. At that point, one railroad produces two very different ledgers. On Union Pacific's books, construction is a cost. The railroad raises money, takes on obligations, pays contractors, and receives a long-lived asset in return. On the construction company's side, the same payment is revenue. The contractor pays its own labor and material expenses. What remains can become construction profit. Building the railroad was itself a business. That changes the meaning of the earlier numbers. A dollar leaving Union Pacific as construction cost could appear somewhere else as contractor revenue. The bondholder saw a debt security. The shareholder saw an equity claim. Management saw a network that had to keep earning enough to operate. A construction insider could see a contract that paid during the building phase, before decades of future passenger and freight revenue had been collected. That does not mean every insider earned the same return. It does not mean every construction dollar became profit. The exact outcome depended on the contract, costs, ownership, and timing. But the structure is clear. The same railroad created several economic positions, each with a different route to gain. And once those positions are separated, another question becomes unavoidable. Who carried the obligations created by all this money? Federal assistance lowered the barrier to construction, but it was not free money with no strings attached. Government support came through legislation, land, and bonds. Those arrangements created legal and financial claims. Debt solved a present cash problem by creating a future payment problem. Transportation revenue also came with its own burdens. Freight required equipment, track, crews, and reliable delivery. Passenger service depended on the same network remaining safe and usable. A larger route could attract more business, but every additional mile also had to be maintained. Government transportation shows why revenue and cash received must stay separate. Court records document disputes over compensation for carrying government mail, troops, supplies, and public stores, while the government also asserted claims connected to railroad financing. For the railroad, that timing difference could matter almost as much as the amount itself. Payroll, maintenance, fuel, and financial claims do not wait politely for every customer account to settle. The service could be performed. The railroad could claim payment. The cash could still be delayed or disputed. That distinction matters in a business with large obligations, coming due whether customers or governments pay quickly or not. The greatest liability was therefore not one damaged car or one broken locomotive. It was the combination of a huge fixed network and financial claims that continued even when cash became harder to obtain. That combination made railroads powerful, but not invulnerable. Traffic was one risk. If passenger or freight demand weakened, revenue fell. The physical network did not shrink with it. Credit was another. Railroads relied heavily on outside capital. If investors lost confidence in railroad securities, refinancing or new borrowing could become harder even while trains were still moving. Then there was the operating burden. Maintenance can be delayed for a while, but not forever. Equipment wears out. Track deteriorates. A network starved of maintenance eventually damages its own ability to earn. Ownership conflict adds another pressure. Managers, creditors, shareholders, and contractors do not always benefit from the same transaction in the same way. The Panic of 1873 makes that vulnerability visible, but it has to be used carefully. Railroad finance was deeply involved in the wider crisis, and collapsing confidence showed how dangerous a capital-dependent industry could become. But the evidence does not support saying that the panic simply destroyed Union Pacific in 1873. Its reported operating results remain substantial. That is the more useful lesson. A railroad can be operationally strong and financially vulnerable at the same time. The failure chain begins with enormous capital needs. Those needs create debt and securities. Debt creates fixed claims. A traffic shock or capital market shock weakens revenue or access to money. Physical and financial obligations fall more slowly. Cash tightens. Refinancing becomes harder. Maintenance and expansion become more difficult. Default or reorganization can move closer. The key variable is not whether one train is full. It is how far revenue can fall before obligations consume the operating cushion. The surviving numbers let us test that cushion. This is not a complete annual ledger reconstructed down to every expense. The surviving reports and historical compilations preserve useful operating figures, but they do not give us every cost required to calculate one universal economic return for every investor. So the safest test is to compare the railroad's reported operating cushion across several years, then keep that separate from shareholder wealth. In 1870, historical compilations place gross earnings at about $7.6 million. Operating expenses and taxes were about $4.7 million. That leaves an operating surplus of roughly $3 million. In 1872, gross earnings were about $8.9 million. Expenses and taxes were about $4.8 million. The operating surplus was a little over $4 million. Then comes 1873. Despite the financial panic associated with that year, Union Pacific's gross earnings were reported at about $10.3 million. Operating expenses and taxes were just under $5 million. The remaining operating surplus was roughly $5.3 million. Those numbers make one thing clear. The railroad had become a serious operating business. But they do not tell us that an ordinary shareholder personally received $5.3 million, or even a fixed portion of it. Operating surplus still sits above other questions. Interest, financing structure, distributions, reinvestment, and the price at which an investor bought or sold the stock. The approved evidence does not give one universal shareholder return. An investor who bought at one price, received one pattern of distributions, and sold at another price could have a very different result from someone who entered later. Without that timing, the safest conclusion is about the business system rather than one imaginary investor's exact return. For a weak year test, we therefore have to use a stress scenario rather than pretend a complete bad year ledger survives for this period. Assume revenue falls sharply, while track, equipment, permanent labor, administration, and financial obligations decline much more slowly. Some operating expenses would fall with activity. Others would remain. The exact break-even point cannot be established from the approved evidence without inventing cost behavior that is not documented. But the sensitivity is visible. The danger lies in the gap between fast-moving revenue and slow-moving obligations. And that distinction carries directly into wealth. A railroad can produce an operating surplus. A contractor can earn from construction. A creditor can receive interest. A shareholder can gain or lose through dividends and equity value. Those outcomes are connected. They are not interchangeable. Union Pacific and Crédit Mobilier leave us with two outcomes that only seem contradictory if we insist on treating the railroad as one business with one pool of profit. Union Pacific became a real transportation system. Its early 1870s records show substantial earnings from moving people, freight, mail, and other traffic. The tracks were not an empty excuse for finance. At the same time, Crédit Mobilier shows that construction created a separate economic opportunity. Money could be earned from building the railroad before the operating company had spent decades collecting fares and freight charges. So, could you get rich by owning a Wild West railroad? Yes, but simply owning railroad shares was only one position inside the railroad economy. For the railroad itself to succeed, traffic had to support a huge network. Operating costs had to remain manageable. Maintenance had to continue. Capital had to remain available. The financial structure could not consume the business faster than the trains replenished it. The main failure mechanism was the mismatch between revenue that could weaken quickly and obligations that could not. The path to wealth depended on position. That is why the same railroad could look attractive for completely different reasons. One participant wanted contracts paid during construction. Another wanted interest. Another wanted the company to retain enough operating strength to support the value of its equity. Those interests could overlap, but they did not automatically align. A builder could monetize construction. A creditor could hold a contractual claim. The corporation could earn transportation revenue. A shareholder owned the residual upside and remained exposed to what was left after other obligations were met. Go back to the investor standing beside fresh track outside Omaha. At the beginning, the opportunity looked like a train carrying paying customers west. By the end, the train is only the visible part. Behind it are bonds, land, construction contracts, freight, government payments, maintenance, debt, and competing claims on the same railroad. The railroad sold transportation, but the railroad economy sold something larger: control over where capital, goods, land, and people would move next.